Hello, let's take a look at exercise 8-4. Um, I'm trying out a new video software. So I found that before I was having trouble switching between screens, so it was harder for me to show you the question and then show you the answer. So I'm giving this one a try. If you don't like it, just someone comment and let me know, and I'll go back to the other one. Okay, so it says the following questions involve the same manufacturing company in two different sets of circumstances. In both, the cost structure of the company is constant. Selling price, unit variable cost, total fixed cost are the same every year. Unit sales and or unit production levels are what's changing. So we're told, consider the following data in scenario A. Were unit sales constant from year to year? Well, from looking at this, what do you think? It's kind of hard with absorption costing operating incomes because it can change with sales and with production. But the one that will give it away is variable costing. Variable costing is affected only by sales, not by production. So variable costing here is staying the same from year to year. So therefore, sales are staying the same from year to year. Then in part B, what was the relationship between unit sales and unit production levels in each year? We need to say, did inventory grow or did it shrink? Well, in year one, they were the same. So everything that was produced was sold. In year two, absorption costing is higher. The operating income is higher than it is under the variable costing method. So if absorption costing is higher, there was more income. That means there was less expense that year because sales were the same every year. So there was less expense that year. So if there was less expense, that means there were some fixed manufacturing costs that were deferred in inventory. So if they were deferred in inventory, that means inventory had to grow. And then the following year, the opposite happens. Income is higher under variable costing and it's lower under absorption costing. So if income is under absorption costing is lower, that means there were more expenses that year. And for there to be more expenses, it would mean that some of the fixed manufacturing costs from year two that were deferred in year two, they are now happening this year. So they are being expensed. So amounts that were inventory that was there from last year is now being sold this year. So that would mean that everything that was produced was sold, plus they had to take some of their beginning inventory and sell. So the fixed costs from last year are now being expensed this year. So there's more they're being expensed, there was more sold, so inventories shrunk. So if we go and just look at our, here we go. So like I said, in year one, the two were equal, so production was equal to sales. In year two, absorption costing income was higher. That meant production was greater than sales and inventories grew. And in year three, variable costing was higher than income under absorption costing, so that means production was less than sales and inventories shrunk. Now, if we go back to the question, now in scenario B. Now our income under the variable costing method it's decreasing. Absorption costing income is increasing. Were unit sales constant? So if I'm asked a question on unit sales, I look to variable costing. And because it's affected by sales, it usually moves in the same direction given everything else remaining constant. That's why they told us that everything else was the same, that only sales and production changed. So given the fact that everything else is constant, our variable costing operating income is decreasing every year, so I'd say our sales are decreasing every year. And again, did inventory increase, decrease? Well, we have the same scenario here. Everything was the same for under both methods. So production and sales were the same. Everything that was produced was sold that year. In year 2, absorption costing is higher. So again, if absorption costing is higher income, and we know that would again lead us to believe that some of the costs, fixed manufacturing overhead costs, were deferred in inventory. They were deferred to a future period. So if fixed manufacturing costs were deferred in inventory, that means our inventory grew. And if you look at year 3, it's the same scenario. Absorption costing is higher, has a higher income than variable costing. So again, our inventories that year would have grown. So if we just double check, you can read through this stuff yourselves. But again, year 1, they were equal. So inventories were the same. In year 2 and 3, absorption costing income was higher both years. So that means production was greater than sales, and that means our inventory grew. Okay, take a read through the question. It does give a lot more detail there, but that's basically the gist of what's happening.